Hey guys, it's Adam Rose, Vice President, Senior Loan Officer of Western Ohio Mortgage here in Sydney, Ohio, and this is another episode of the Mortgage Guy podcast. And this week you get to learn about homeowners insurance and what to expect. And I have Matt Echols from Billings Insurance in Anna, Ohio, and he's going to kind of dive into it and kind of take us through this process so you guys know what to expect and how it all works. So first off, thank you, Matt, for taking the time. I know it's a little overdue.
Yeah, no problem.
We've been talking about it for a couple of months now, and we finally did it. But first thing we've been doing with guests on the show is kind of getting to know you a little bit better. So we do a little bit of an icebreaker, which I usually forewarn people about because I can't think of one off the top of my head that's interesting. So any irrational fears that you have that people can make funny about?
Yeah, irrational fear. So everybody's heard the term, you step on a crack, you break your mother's back.
Oh, no. Yeah. Mm-hmm. Okay.
And so I'm constantly just walking, daydreaming, whatever, I'm looking down and I see a crack and I don't walk over it. Well, then it's like concrete's cut every 6 foot. So I literally...
So you see a stutter stepping all the time?
I stutter step and I'm like, hey, can't do it. I don't know what I'm going to hurt. I don't know who I'm going to hurt, but I'm just not doing it. So
childhood fear?
Yeah, something like that.
Yeah. Superstitious, right?
Yeah.
Growing up in baseball being my main sport, that's, that we're extremely superstitious people, right?
Sure.
Going through tournaments, you don't wash your socks, that kind of weird stuff. So that's a childhood thing that kind of carried with you.
Yeah.
So the first thing we're going to dive into on the homeowners insurance side is a lot of people don't really know what to expect. And it's the same for the mortgage process, right? We do buyer education on, hey, when I talk to you, expect this. Here are some of the questions that we asked and some of the information that you should know that we're going to have to discuss. What's that look like on the homeowners insurance side, right? So if I have a client, I want to send them over to you, what kind of data and information is needed to really generate a quote or a premium or an idea of coverage amounts and costs for these clients? What should they expect?
So actually, it's a lot of the same process that you asked, the questions that you ask. So it's, name, date of birth, driver's license number.
Okay.
Those are the main things that are going to help us determine a quote. And a big thing is property address. What's the place you're buying? Where is it located at? Mm-hmm. And in order to do kind of a soft credit pull, what's your previous address? Where you're moving into this house now, where were you at before? Because a lot of the data is going to pull from that background.
Correct.
And where you've already been. So it's all through LexisNexis, things like that. So it all comes to that. So that's pretty much it. Household members need to know that type of information. But that can really just get us started.
Okay. Very good. So on that topic, we talked about premiums basically. So we take a look at credit. Now, is that like a credit pull that I would see? Because you know how we're always telling people, hey, don't pull credit. Don't run out there and apply for credit lines and credit cards and all that. From my experience, it does have no impact whatsoever on their credit scores. Is it different?
No, it does. So once we start the quote, the insurance carrier is going to pull that person's soft credit pull.
Okay.
And that's going to be set for a year.
Yep.
It doesn't matter what it is.
So no one is even going to see there was a new inquiry on that.
Nope. It's never documented anywhere. So you won't see it. You won't get a notice.
Very good.
Nothing like that. So that's going to start that rating process to where, okay, we determine a score. Mm-hmm. It's set. Now let's go. And
does it show things like some of the information you're pulling? Because I want to talk about, what's really affecting their premium. Right. Obviously, we know, hey, I got a $500,000 house. Obviously, that's going to have a bit of an impact because the amount of coverages. But things like credit. So does it show up like, hey, these people abuse insurance constantly, right? Is there information out there that shows that?
So not necessarily from the credit perspective, but from the clue report that we pull about losses. So losses are going to come in and determine what your rate is as well.
Okay.
And the clue report is a comprehensive loss underwriting exchange. Everybody gets pulled. Every property, every person, they get pulled every single time, and I'm not going to give a customer a quote unless I actually pull that and I know that.
Right.
But I don't see anything else.
So someone out there watching this might be like, well, I don't even own a home, so I shouldn't have any claims. But it's really looking at claim histories on all insurance fronts, right? Car insurance, or is it?
Some companies do, but most companies do not. Most companies, it's just going to be on the home and that property address.
Interesting.
So if we put the property address in for that customer and it comes back that there was a claim, it's not necessarily on that customer. It could actually just be on the property. So we have to go and determine that, hey, what was the loss? Well, this is a new buyer, so we know that loss is not them; it's on the actual property.
Interesting. Okay, I didn't know that.
It's not gonna go against that customer.
Right. Okay. Very good.
But sometimes also it's a benefit to the customer. Like, hey, they had a wind loss 2 years ago. What's the age of the roof? Well, it's only
brand
2 years.
new.
It's brand new.
Nice.
So, okay, well, we know that based on the loss of the age of the loss.
All right. So, and there's other things that can affect premium, obviously. So, we were briefly talking about, where you're residing at, like, how
Yes.
close it is to the city or fire department or water source. What is that all about?
So the biggest determining factor aside from credit is huge. The other one is property protection class.
Okay.
So we go through, there's several different levels, but basically on a basic number, it's 1 through 10. So a 1, which there's really no 1s out there. There's a couple 2s when you get into Columbus area, Dublin, places like that. There's a 2, but for the most part, we're a 3, 4, 5. So right in that ballpark.
Okay.
Now you start to get to a 9 or a 10. A 9 they're pretty far away from a fire department. So if they have a loss, and on a 10, they have a loss, the timeline from a fire department getting to that property is going to take longer.
Yeah.
So to mitigate the damage, it's going to get more expensive and more expensive because it's going to take longer for the fire departments to get
Right. So, like, for example, myself, I'm probably 7 or 8 miles away from the
You're going to be a protection
closest
class 9 or 10.
But as a volunteer fire department, does that also have an impact?
Absolutely.
Yeah, exactly.
Yep, absolutely.
So they're not there just
they're
waiting
not
on
there.
the call.
So they got to get in their truck, drive to the station, and
Right.
jump and go.
Right. So yeah, it's going to take a little bit longer. So does it help to have like water sources on property or anything like that? Does that impact it at all?
It's not a huge determining factor, but they like to know.
Right.
So some companies will ask, is there within 1,000 feet, is there a pond or something like that?
Right.
But is it going to change the rate? Not necessarily, because the fire departments and ISO are determining that class already.
All right. Very good. So another question we get a lot on, and I'm sure you get it all the time because you're actually in insurance, but when it comes back, when we get a quote for a client, they're wondering and they're looking through their coverages, they're like, why the hell am I buying a $150,000 house with my insurance coverage for $450,000? It's usually
classic.
Replacement cost, right?
Yeah.
That's the common question.
Common question.
But you would think common sense should apply to that situation. It doesn't always. So is there a calculation? Is there something how insurance companies are determining that information?
So what we do is when we get the property, we know the property address. So we're going to do research on what the house is like. What's the square footage? Is it 1 story, 2 story? Does it have a basement? Does it not have a basement? And we're going to plug all that information into a replacement cost estimator. And so all the carriers have one. They use several different carriers or several different companies. And so we plug that in. What's the square footage? Is it 1,700 square foot? Is it 2,200 square foot? Is it a 1 story, 2 story? Like I said, is it a Cape Cod style? Is it not? We go through all of that, and we're going to determine that's going to help us determine what the cost is to replace that house. Mm-hmm. And so when you buy a house, it may be older house downtown, but it has a lot of square footage with it. So what's the cost to replace that house as opposed to what the market value is? Those market values are typically a lot lower. Right. However, the replacement cost on that property is a lot higher. So you're talking, what we look at is in building costs right now is anywhere from $200 to $300 a square foot.
Right.
Well, if you look at a purchase price, it may not be that. It may be 100, 110. So if you let's take a 2,000 square foot house, and the market value on it is only $175 for purchase.
Right.
We're going to probably insure that for $350.
Right.
And that's just how it is. And because we don't care about what it costs to buy it. With insurance, you're buying, what does it cost to replace it?
Right.
So if that house was a total loss at this point in time, right now, what do we have to spend to fix it and rebuild it if it was a complete loss?
Right. Yeah, and it's taken into account, custom builds. It's taken into account skilled labor, the cost of material, and which, obviously since COVID hit, we've seen go up dramatically, right? I mean, all the insurance companies across the board, not just homeowners insurance going up, but car insurance is going up because the length of time it's taking to fix cars, the availability of parts, and all this stuff, right?
Everything.
It's all gone up, and it's one of those things that that people don't think about when they're buying a house, or when the talking heads talk about how strong the economy is and inflation has been tamed, and it's only costing a few extra $1,000s a year for you to live in this inflation world. It's impacting everything
across the board, and just on the auto a little bit.
Yeah.
You typically last several years, it's been $2,000, $3,000. Somebody hits a deer. That's what it costs to fix it.
Yep.
In just this short time, it is now $6,000, $7,000, $8,000 to fix it. And so when you can look at insurance is taking premium from all the customers, and it's in it's in one pot.
Yeah.
And so when you're drawing out with what the insurance companies expect, you're drawing out X amount of dollars per claim. The actual claims haven't changed. The amount of claims haven't changed, but the cost to fix those customers, that has changed drastically.
Yeah.
Drastically.
And it's the same thing in homeowners insurance, right? So it's not saying, oh, we've had so many claims over the last 2 years, that's why it's going up. It's just if we have a claim, it's 50% higher than what it used to be
before.
Right?
Yep.
Exactly. So,
Yep.
And another thing is because I get calls all the time if something goes wrong with a house or like an AC unit goes out or HVAC unit goes out, and they say, hey, does my homeowner's insurance cover this? Typically, that's a no.
Typically, it's a no.
That's a no. So I've learned there has to be a cause and effect.
Exactly.
Right? So what does homeowners? So if I send a client over to you, and they have homeowners insurance, there's some standard stuff that's always in there, and obviously there's riders that can be put on there. So what does a standard policy typically cover? What does it do for us?
So there's two parts to that kind of. So there's the coverages I'm going to go through a customer is I'm going to base the replacement cost of the house, and so that replacement cost is going to be determined, and then of that. There's the standard coverage A, B, C, D, E, F, all the way down through. And so what coverage A is the value of the house. Coverage B is going to be your other structures. So that's any other things on the property. You have a shed, you may not have a shed. Either way, you're getting that coverage.
Right.
Then the other part is coverage C, personal property. So you have personal property, it's going to be a 50 or 70% of your coverage A. And let me back up real quick. Coverage B is going to be 10% of coverage A. Okay. So if you have $200,000 house, you have $20,000 for other structures. Coverage C is if it's 50%, you have $100,000 of coverage on your personal property. That's standard. It may be 70, so you'd have 140,000 or whatever.
A borrower can request changes to that. Is that correct? Okay.
Absolutely.
Like,
yeah.
hey, I've got custom-made furniture.
So
everywhere,
you may have an extra building on your property that's worth $80,000. Well, we're going to schedule that differently.
Very good.
We're going to
this is the standard look.
Standard.
Yeah. Okay.
Yeah.
Very good.
Because not everybody has it. We're tailoring your insurance policy to you.
Right.
So we're going to go through each carrier and try to find the best premium, but we're going to overall go for the coverage.
Wow. Someone turn out the lights on us, guys. We're going to pause it right there for a second. Justin, make sure you put that in there for a second, would you? Our brand new podcast room and technical difficulties. Okay. So getting back to where we were talking about coverages.
Coverages.
Okay.
So if coverage A, coverage B, coverage C.
Yep.
Coverage C is personal property. So that's all your stuff. I love to say this every time is when you think of personal property, you take your house and you turn it upside down.
What falls out?
What falls out? That is personal property.
Okay.
A lot of guys, even your other structure, you take your other structure, flip that upside down. You got all your tools and everything else. That's going to be considered in that personal property.
Very good.
Yeah,
okay.
So that's
a good way to put it. Yeah.
So coverage D is going to be your loss of use. And this is kind of a tricky one for people to understand, but think of it as this. If you have a fire loss and you cannot stay in your property, now you have to find a new property. You have to find a new place to stay for 1 week, 2 weeks, 3 weeks, 4 weeks. You have 20% of your coverage A for available to pay for you to stay in a hotel, if that's what it takes. Pay for other utilities that you may have, food, additional, anything like that. Mm-hmm. So that is in there. Do you have a question?
No. I remember a client that had a fire years ago that went through that, and they had insurance for staying. They found a rental, and it kept them in there for like 7 months until the home got remodeled and rebuilt.
So
and stuff like
your
that.
policy is going to pay for that.
Yeah,
that's an additional expense. Now you're still going to have to pay your mortgage because you still have your house.
Yeah,
but you can't afford to pay the additional rent now and all that. So your policy will cover that.
Right.
Coverage E is going to be your personal liability. So liability to others. Somebody comes on your property and they get injured or something like that. Mm-hmm. That's a common misconception. People don't understand, what am I buying liability for? It's like an auto. You're buying liability. It's your liability to others.
Right.
So if you cause a person to have a loss, your homeowner's policy is going to pay for that.
Right.
So and typically we do $300,000, $500,000. If we want to go above that, we're going to start talking about umbrellas and different things like that. But we got to look at auto stuff too. So that's a whole other beast. Mm-hmm. So.
I have everybody sign a waiver when they come to my house. No.
That's a good idea.
You should sign this. Thank you.
And one thing about it, too, is immediate family members are not covered under that.
Oh, yeah. So I didn't know that.
I
mean, that probably, because there's probably some insurance fraud, I'm sure that's happened in the past, and that's probably changed.
Yep.
Right? Yep. It's kind of like when we explain to clients and we have this big, giant stack of paperwork. We're like, there's probably a lawsuit for every page that's in here. That's why you're signing it.
Exactly.
Right? Why else would it be there?
Yep. Yep.
Okay.
But if your brother comes over to your property and he breaks his leg, hey,
That's
you're not
too
suing
sad.
me, dude. Come on.
He'll be fine. He'll be fine. Walk it off.
Yeah, exactly.
Yeah, rub some dirt on it. So it says that's all the basic coverages. Is that correct?
Yep, that's your standard policy.
Hey guys, that's going to be it for us this week. This interview with Matt Echols from Billings Insurance is a two-parter, so make sure to tune in and get the rest of the great information that he's providing to all of our home buyers and realtor partners out there in the market. See you guys next week.